Good afternoon friends. This is the sixth video on income tax updates, and various SMSs and emails and on the income tax portal updates are there for all the taxpayers who have filed their returns in financial year 23-24 and financial year 21-22. In case there is a mismatch between AIS and the ITRs, then such taxpayers would have to either reply online in case the AIS is not correct, or tomorrow 31st December is the last date for financial year 23-24 where they can file their revised ITRs or belated ITRs. In case of financial year 21-22, you need to file your ITR-U in case the mismatch between ITR and AIS as auto-populated in your portal is correct. The Income Tax Department has also issued these SMSs and notices to certain high net worth individuals who have various credits in their bank account, high credits, but they have not filed their income tax returns. So such high net worth individuals too need to reconcile their accounts and act to such notices or SMSs. Next important issue with respect to TDS is that we all know that in case a deductor does not deduct a TDS, then he is regarded as a assessee in default and his expense is disallowed by the department where he does not deduct the TDS. However, proviso to section 2011 comes to the rescue, which provides that an assessee cannot be considered to be as a deductor in default in case the deductee has filed its corresponding ITR, shown such revenue as income and paid its taxes on such revenue. The question is that whether the AO or the deductor is under an obligation to verify whether the deductee has shown such revenue as its income in its ITR and paid the taxes, or in case it is not readily available, they can consider the deductor as being an assessee in default. Well, it has been held by the Honorable ITAT Hyderabad in the case of Bhargavi Marketeers that the AO and the deductor are under obligation and it is their responsibility to verify before considering the deductor in default that whether the deductee has paid the taxes on such receipts or not. Next, in these days of increasing imports are the question whether the high seas sales are speculative or not. So the definition of speculative transactions under section 43 subsection 5 provides that they are those transactions where the purchase or sale of a commodity has happened without actual delivery or transfer of the commodity. Now what happens in case of high seas sale? The foreign exporter exports the goods by filing the bill of lading in the name of a purchaser, say A in India. Now while the goods are in high seas, the purchaser A sells the goods to purchaser B, and when the goods land on the Indian port, it is purchaser B who actually clears the goods and pays the import duty on it. The question is whether the high seas sale transaction between A to B is speculative or not. Here it is a fact that actual delivery of the goods have happened and B has taken the actual delivery of the goods apropos the high seas sale, and therefore it was held in the case of Empire Multitrade by the Honorable ITAT Mumbai that high seas sale cannot be regarded as a speculative transaction. Another regularly deliberated and litigated issue is whether ESOP expenses are allowable under section 37(1) or not. Well, ESOP are not notional or contingent expenses as was held in many earlier decisions and now reiterated by the Honorable ITAT Mumbai in the case of Goldman Sachs Securities India Private Limited. It has been held that there are various kinds of ESOPs. In this case, the ESOP expenditure was graded on the basis of vesting of the ESOPs. Say out of 100 shares, 40 shares were vested in the first year, next year 20, then again 20 and 20. And ESOP expenditure were charged to the profit and loss account on such basis 40, 20, 20, 20. It was held that such expenditure cannot be considered to be as notional or contingent. Whether a particular structure is to be considered as a residential property, whether two flats may be considered as a single residential unit or not, these have been long litigated issues. So, the first question before the Honorable Delhi High Court in two important judgments. First, whether a particular plywood structure built in a rural area amidst agricultural land and with a lot of barren land appurtenant to the structure would be considered as a structure or as a residential unit, even when the basic amenities like a robust electricity connection or water supply or for that matter furniture were not present in the structure. It was held by the Honorable Delhi High Court in the case of Sandeep Huda that such a structure without basic amenities, even though in a rural area, could not be considered as a residential unit or residential structure. White Finance Act 2014 amendment was made in section 54 capital F, wherein the term a single residential unit was replaced by one residential unit. Now, the question before various high courts earlier was whether two units, when they are purchased together, to be deemed as one unit or not. Well, it was held in the case of Kamla Ajmera by the same Honorable Delhi High Court very recently that only when two residential units are adjacent to each other and purchased with an intention to be considered as one residential unit, then only such two residential units can be considered as a single residential unit. In case the two residential units are not adjacent, they are on different floors or in different buildings in the same residential complex altogether, then two residential units cannot be considered as a single residential unit, and the benefit of section 54 capital F is to be available accordingly. Another question which is asked for a project under construction or for a project which is under implementation is whether interest earned on fixed deposit is to be considered as a capital receipt or a revenue receipt. Well, as we have held in our earlier videos also, that in such cases the nature of the fixed deposit has to be seen. In case the fixed deposit is made out of surplus funds or idle funds, then the interest earned on the fixed deposits would be considered as revenue in nature and leviable to tax under the head income from other sources under section 56, as was held by the Honorable Apex Court in the case of Tuticorin, alkali, chemicals and fertilizers. However, in case the fixed deposit were made or as a part of the bank guarantees, they were made to the authorities or parties, then such bank guarantees of fixed deposit can be considered as being a part of the process of the erection of plant and machinery, and as held in the case of Bokaro Steel, such interest would go on to reduce the cost of the capital asset, that is plant and machinery, and therefore it would be considered to be as a capital receipt. So the interest is important, but more important is the nature of the fixed deposit for such pre-commencement projects. Specified domestic transactions. In 2017, 1st of July 2017, the clause 1 of section 92BA was deleted. This clause 1 of 92BA specified that a specified domestic transaction would include a transaction or an expenditure which was made to a party as mentioned in section 40A2B. Well, the question was, what before 1st of July 2017, would an expenditure made to a party related under section 40A2B before 1st July 2017 not be considered as a specified domestic transaction? It was held by the Honorable Apex Court in the case of Kolhapur Cane Sugar Works that in case there is no saving clause in a statute where a particular clause in the statute is deleted, then in absence of a saving clause, it would be considered as that clause which is deleted was never there actually. So any expenditure made to any related party under 40A2B would not be considered as a specified domestic transaction under Income Tax Act. Another question in domestic transfer pricing in these GST days is whether, we all know that in GST state-wise trial balance is required. So the question is whether in case one unit in a particular state generates less or very low net profits than another unit in another state of the same SSE, then can certain expenditure of that unit which is generating lower net profits be disallowed and added back? Well, the Honorable ITAT Lucknow bench has held in the case of Parag Industries that in case certain expenditure of any unit which is generating lower net profit also has to be disallowed or added back, the AO has to prove that there is any falsification. The AO has to reject the books of account under section 145 of the Income Tax Act, or there has to be certain evidences which are to be brought on record to prove that there is certain misreporting or underreporting of the income, just due to the fact that a particular unit is not generating sufficient net profit or maybe generating a loss vis-a-vis another unit. A particular expenditure of a particular unit cannot be disallowed or added back. So friends, these are the various updates for the last few bygone days in income tax. Thank you for watching. Do stay tuned. Do like, share and subscribe to this channel. Thank you very much.